Welcome to the daily update, where I'll go over the action in the market for Wednesday, November 6th, and we'll see how things look for Thursday, November 7th. A really solid update. Now, in some of the other videos that I post just on the website, I was saying watch for selling into strength, and we saw a little bit of that at the beginning, but no, the market just wanted to go higher. It's probably a lot of relief that the election is over, that it was pretty decisive. We still have the House to yet determine, but it looks like there'll be a Republican president, a Republican Senate. That has switched over. And we did have a Republican House, but it's it depends on who you listen to. Some say it's going to stay Republican, others say it's going to switch over to Democrat. We just don't know yet. And now the market would like it if things were different. If one part of Congress is Republican, the other part is Democrat, because that produces gridlock. And but then you have other folks that say, well, we need everybody on the same side right now to try to implement some changes. People on the other side saying, oh, look, everybody's on the same side. They're going to do everything to destroy the country. So it just depends on where you come out. All right, but we have now switched back to positive on all time frames, short, intermediate, long term. We still have a few intermediate term indicators that are negative, but really improving. We've reclaimed the 20-day moving average and then some. We're well above it. We set an all-time high, not only with the S&P, but the Dow, the Nasdaq 100, mid caps. The only thing had a good day were the small caps, but have not set an all-time high. We even set an all-time high with the transports. And so it looks like we're going back into growth mode. We're coming into some positive seasonality, and the market is shifting back into a more, okay, let's go up from here because we see the economy doing well. There's a big variable yet for Thursday's session, the Fed. Now, it's pretty much sure that they're going to cut rates another 25 basis points. Whether you agree with that or don't agree with that, that doesn't matter. It's what the market has already been figuring in at this point. There is a little bit of concern that inflation could come back into the picture because things might switch to more of a growth mode. That's why we saw interest rates going up. The dollar surged. It's like everything was up. Bitcoin doing really well. And it was just a buy everything day. And a lot of it was based on relief, but also emotion. So just people throwing money into whatever the market they could, not really using any logic behind that. So on a short-term basis, that makes us a bit more vulnerable because we probably overdid it to the upside. You have these people they fear that they're going to be left behind with the market going up, but there's also a real relief. But now we have this period of time from the election until the inauguration of the president. What weird things are going to happen there? Are they going to validate the electoral college vote? Still lots of things. Because there's this window of time. Is that going to spark Russia to step up things in Ukraine? Is that going to spark up Iran to step up things against Israel? They've already said they were going to wait. Iran did. They were going to wait until after the election to do something. Okay, now they know they only have a window of time because President Trump is known for being somebody that actually puts a little bit of fear into the leaders in Russia and the leaders in Iran and North Korea and even China. Whether you believe that or not, that's how it tends to play out. And so we'll just have to see. So we want to keep an eye on all the different geopolitical things, naturally, because once the election kind of fades out of the main news cycle, then some of these other things could end up coming back in. Okay, I have a thing called the SPX Investing Program. There are additional videos that I post there that I don't post on YouTube or Rumble. There's a link that'll take you to the website or to a video that talks more about the program. You get the videos as soon as I prepare them. Here's an email address if you see the need to contact me. Also, the daily videos where I do the real foundation of my analysis. All the weekly videos are meant to tie into the daily video. Okay, so we had a huge higher gap open. We were up over 2% with the open. At one point we were up to about 2.25%. We came down to about the 2% level right at the open and then just shot right back up after that. We opened up at R3 Okay, and that's the one I have to calculate. We never made it up to R4, but we opened right around the R3 level at 58.85. There was some initial chopping that went on. That's what I was watching for. That was what I was talking about to look for in I do a pre-market open video, is are we going to see some selling into strength? And initially we did. There were folks that wanted to lock in some profits. There were some shorts that had to liquidate their positions, and they have to do that to buy. That helped push things up. And once that initial gyration got over with, then we held on to those gains for the most part and closed slightly off of the intraday high, not quite up at R4, but we're well above 5,900 now. So we were up over 2.5%. That's a big move. Now, there's been other times, and I've been doing this for a long time, where we can see 3, 4, even 5% moves in one day, but that's not what we've been seeing lately. We've been, you get a 0.5% to a full percent move. That's kind of a big move right now. We'll see if the market's going to start to show more movement, either up to the upside or downside. And we were well above average with volume. So that really picked up as well. And as I said, we are now back to positive in the short, intermediate, and long term. We still have a few of our intermediate term indicators that are negative, but they're showing a lot of improvement. Thursday's session is going to be about interest rates. Inflation seems to be under control for the time being, but now it's about the Fed. We switch from the election over to what's the Fed going to do. Looks like they're going to cut rates. And then what are they going to say? What's going to happen in the press conference? And then the geopolitical things that I alluded to. I still have the U.S. election here on the list just because there could still be some fallout, and it's not necessarily official, at least yet. It won't be official until in December when they actually um, accept the Electoral College vote in Congress, where the states submit that to the U.S. Congress. Okay, so the S&P, NASDAQ 100, NASDAQ, miscaps, that's good. Little typo there. Mid caps, and the Dow set new all-time highs. The small caps were strong. Everybody kind of went along for the party here. The transports did set a new all-time high if you just look at the daily chart. And then initial election reaction has switched to growth mode. That's kind of what I'm calling this right now. Now, growth is not necessarily outperforming value. Everything went up in Wednesday's session, but this is an anticipation. Now, one of the unique things that we have in the US right now is Trump was already president before. And so we kind of know the things that he did then or that he'll do now based on what he did in the first 4 years when he was in there. And there's an anticipation of the tax cuts. They're going to be extended. There was a lot of fear under Harris that they would not be. And people weren't really talking about that or thinking about that. And suddenly we're going to get hit by this. And that can apply to corporations as well as to individuals, and that there'll be fewer regulations. In the first 4 years that Trump served, he cut a lot of regulations, and the market likes that. The stock market is built around capitalism. Just let demand and supply lead things higher or lower, and let the integrity of capitalism actually try to play out, even though there's a lot of crony capitalism that goes on. But then there's these things called tariffs, and you've got one side saying, oh, this is terrible, this is awful. You've got other sides that are saying, no, this is pretty good. This is going to help American companies to be able to produce things instead of having them produced offshore and then shipped in, with the idea of hopefully switching back more to a manufacturing type of economy where we're now more of a service-oriented type of economy. So this could end up, if the tariffs actually go through, and a tariff is just like a tax. It's like, okay, you can send us your car, but we're going to tack on 10 grand to the price. And then, of course, that gets passed on to the consumer. The consumer's like, okay, I've got to pay 10 grand more for this car. I'll just buy the cheaper car that was built here in the US. That's a very simplified version, but it's a form of a tax there. And that will help some companies, but it could also hurt other companies that do international business. The 50-period moving averages, yeah, they are holding. Okay, this is actually incorrect. We are above the 20-period moving average. I forgot to take that line out. The VIX, I was watching that. We got down into the 15 level. We're down around 16 now, but we had been above 20. So we saw a real drop off in the VIX. And we want to keep an eye on the Middle East. Oil really didn't do all that much. And we have our usual suspects here in the short term. This is showing good short-term momentum or the fact that we're overbought. We tend to be willing to ride this a little bit longer because the intermediate term and the long term are positive. So we can stay this way for a while. But for right now, the Stoke RSI, Williams percent R, if you watch these videos, you hear these words over and over. The CCI 14, 20, stochastics, the force index, which is not always on the list, but it just shows the upward thrust that we saw, and the boom indicator based on 20 periods. We're getting a little far away from that 20-day moving average, and we're getting kind of far away from the 50-day moving average as well. The Arun has now finally come to life and spiked back up. The Sean trend meter, initial part of being overextended to the upside, and the percent B. That's based on the Bollinger Bands. We closed above the upper Bollinger Band. We tend to not stay there for very long, and I'll have a chart to show you of that. And we're still looking solid. It depends on how you look at this, either overextended to the upside or good long-term momentum with the 150 and 200 period simple moving averages. No changes here to the overall scenario other than the election's over. But this scenario tries to deal more with, okay, what is the Fed up to? What is the market anticipating that the Fed will do? There's still the 25 basis point rate cut that's anticipated, but then what are they going to say? The dollar was up really strong. Interest rates were also up because now it's like, okay, well, these stocks are up because they think the economy is going to start growing again, and interest rates are going up to try to curtail any type of inflation coming into the market. We're at 4.43% with the 10-year yield, where we had been at 4.29% before. We're still inverted with the 10 to the 3 month. The line's coming up, but it's still inverted there. We're still regular or uninverted with the 10 to the 2 year. Sentiment really ticked up to positive. We had been at 43. We kicked all the way through the neutral camp and ended up going up to 58. So we kind of roll with that. People are feeling a little bit better. We've switched back to a positive trend. The green line has now crossed above the red line, but it's still weakening because this going up and down, red, green, green, red. It's like the Canadian TV show. But we just switched over negative a few days ago. Now we're switching back positive again. So the ADX is still weakening. It needs to figure out, okay, what kind of a trend is really happening here? So it's still going down and it's below its moving average, but we're still above 20. So we are trending. The up day makes our bias positive, and now I've switched our momentum over to positive. You can't have 2.5% advances in the S&P and not be looking more positive. Now, that doesn't mean we're going to go up from here because we might have overdone it on a one-day basis, and we don't know what the reaction is going to be to the Fed. Okay, we just had the MBA Mortgage Applications Index. That was it. We do have a slug of information coming out on Thursday, and then we'll have consumer sentiment on Friday, but mortgage applications are down 10.8%, and a lot of that has to do with rising interest rates, down 19% with refinance applications and down 5% with purchase applications. And here's a chart showing how it's dropping off. It's been negative the last number of months. Right about the time the Fed came in and cut rates, we've been seeing this negative because rates are going back up. You would think rates would have been coming down, but that's not what's happening. Okay, and then here, valuations based on forward and trailing operating. Now, I do a version of this where over the weekend with the intermarket analysis video, we look at the trailing earnings, and then we look at the forward earnings. Well, this takes both of those and puts them on the same chart here. And we're getting, we're going up here. And even when you look back on the forward estimates, we're still up over 21 right now. We're above that 20 level. So even looking forward, we're expensive. We're on a historical basis, we're looking even more expensive. And that's the red line's based on trailing the TTM or trailing 12 months. And then the black dash line, that's the average PE ratio. And then the red dash line, that's looking at the trailing earnings that way. Okay, and then here's some gobbledygook here. The takeaway is don't give up for more gains in 2024 when it's up. And I have to move this bar here. When it's up 17.5% after the first 10 months, so October ended, what does it look like going forward? The average in November's we're up 3.3% with the median 3.1%, and we're up 85.7% of the time. December, nice little returns, up 78.6% of the time, not quite as strong. But when you take November and December together, it's up 100% of the time. So we see that here based on what has actually happened. No guarantees because anything weird can happen. But that's why we're seeing more positive seasonality that could be coming to the forefront now. Okay, then consolidated equity position still above zero, but it had been dropping off. This is probably going to change. This is charts undoubtedly a few days old before we saw Monday and or Tuesday and Wednesday's gains. And most money is still going into tech, even though that has been dropping off lately. And we're seeing a lot of money. Bitcoin's hitting an all-time high here. Seeing a lot of money going into cryptos. Now you could take that a couple of different ways. On one side, it was like, okay, we're going to get into cryptos because we think that the Fed's going to come up with their own version of this. They already have. It just hasn't really been launched yet. And we want to get into this because we're going to fight for independence because we want Bitcoin to not be centrally controlled. Then on the other hand, it's like, okay, well, with the change in administration, maybe that's going to give the freedom to the cryptocurrencies to actually do what they were designed to do. So again, it depends on where you look at things, how you come out. Economic surprise index, this is another reason why we're seeing interest rates going up because the economic reports have been coming in stronger than expected. And if you go back here, this does not necessarily include the latest employment report. I mean, that was weaker than expected. But when you take all of these together, the market's been showing some real strength, coming in ahead or above economic report estimates. Then what's the implied U.S. recession probability? Coming down, but we're right around 30% or so. And then this is NBER. These are the folks who actually say, yes, we are in a recession. No, we're not. It's not an economist. It's not a group of people. There's an actual organization that determines these things. And then dollar hits one-year highs. Trump trades gain momentum. So we're just seeing the dollar really going up. The country is seen as stronger. It's seen as being able to do some things to fix some problems that the market was seeing. But that doesn't necessarily help stocks because they like a weaker dollar because of the conversion rates and the import-export relationships back and forth. But at least in Wednesday's session, the dollar was off to the races. Then gold, it stopped tracking U.S. real rates in 2022, where we're seeing the 10-year yield based on the tips. These are Treasury inflation protected securities. And it only stands to reason that they're going down because they adjust for inflation when gold has been going up. So we're seeing a real disconnect here. Because first of all, gold is a hedge against insanity. Well, now that maybe some of the election insanity has passed, at least for the most part, is that going to be a pressure on gold? We're not really seeing a rise here with the tips. Now we are seeing a rise with the other maturity of bonds, especially the 10-year bond. But you can see there's a really strong correlation here. What's going to have to happen to get this back in line? Is the light blue line going to go up? That means that the tips or the yield is going to go back up, or is gold going to come down? Or is this just the way it's going to be going forward? All right, did find a couple of interesting charts here on Twitter. This was put out by Bloomberg, the rally fades after the inauguration. This is kind of a seasonality chart here where we come into the election, then we have the election day, then we have the honeymoon period in here. If everything goes good there, then right after whoever is sworn in for president, that's when we tend to see more of a fade down here. And then things typically will go positive later on after the election. Just something to keep in the back of your mind here. A stronger dollar is bullish for defensive. That's why the dollar was doing better. We were seeing staples, utilities have been doing better. Those are the defensive areas. While a weaker dollar is bullish for cyclicals, they tend to go more with the economy and particularly materials. And this, you might want to pause this and look at this. I'm thinking of using a version of this chart in the course that I teach. This is why we talk about staples, utilities. They've been stronger with a weaker dollar, with a weaker dollar here because the dollar had been under some pressure. And then over here on the right side, we see where materials, communication, industrials, those are impacted as well. And that there's a pretty strong correlation between this. That's why we watch these different sectors of the markets. How they're behaving can give us some clues as to what's happening with the overall index. And this was kind of interesting. Of course, if you listen to many of my videos, I think Jim Cramer should be avoided at all costs, especially if you make a decision based on what he says. He just viewed as entertainment. The guy's a complete rodeo clown, always has been, always will be. He's just trying to get into people's emotions here. And there was a headline I came across. Jim Cramer says Monday's market action suggests some traders anticipate a Harris win. Well, how accurate did that end up being? Okay. Then Yardeni had an interesting chart here. I go through this in the intermarket analysis video each weekend where we look at all the sectors and then we compare them to the S&P. This is putting them all on one chart. And of course, we have tech doing the best here. And then the blue area, that's communication. These are growth areas. Now, if these continue to go up, that's going to do really well. Discretionary has been coming on strong lately. That's the green line in here. We want that to continue to do better. And then some of these other areas may drop off if we are actually dropping back into more of a growth type of phase. Like the pink area here, utilities under some weakness lately. Then we have staples, which is kind of a purple line in here, also seeing a little bit of weakness. And I know this looks like rainbow spaghetti in here, but you might want to just look at this chart. And then these charts are freely available on Yardeni's site. You can go to yardeni.com and he's got hundreds and hundreds of charts that you can look at. All right, here's the chart of what happened intraday. Massive gap higher right up to R3. R4 was way up here, so I didn't put it on the chart. The gyration that we saw initially, it's like selling into strength. No, we're going to do some buying. We're going to sell. And then poof, we go up. We pretty much closed off of the high in the session. And not much of a change right now in the initial overnight session. If anything, just a little bit of weakness. But no, I thought Tuesday would be calm and we just shot to the upside. So, even my own intuition, I don't pay attention to it. I just say, what are the charts actually telling us? But things typically have a little gyration right after the open on Thursday, and then it might settle down, and then the Fed will come out with their whatever they're going to do, and then the market will react to that. But I've said that before, and the market's shot up or shot down even before the Fed made their announcement. Now, both of these are looking pretty good right now. The blue line and the red line, they're both going up. We've seen the blue line above the red line, and that's more for growth. But growth didn't necessarily outperform, even with this big up move. Value saw a really good day as well. And you can see that overall, since the Halloween or so, we've been seeing a bit of an improvement with the growth to value ratio for the S&P. So this is improving, but not really breaking to the upside, at least at this time. So we were up 2.54% with growth, with the large caps up 2.45% with value. So they were both really solid, up less with the mid caps. And look at this, small caps up less than small cap value, but still up over 6%. I mean, that's a monster move here. So seeing a bit of an improvement with small cap growth to value, but still in a longer term downtrend. Also going above the moving average here, but in a downtrend for the mid caps. Actually declined a little bit, but still in an uptrend when we look at S&P growth to value. And we're still kind of in the rainbow right now when we look at the growth versus value ETF. But discretionary, look at it, just really doing well because we saw some weakness in staples and some strength in discretionary, and that's what happens to make this ratio go up. So that's more positive for the market too. Setting an all-time high with large cap growth. And this is the ADX where it's been a little confused lately. It crossed over negative, now it's crossed back over positive. The green line really shot up, the red line's going down. We're still below the moving average. So it's going to take a day or two for this to decide, okay, what's going on here? And once it picks up a trend, then the ADX will start to turn up and go above its moving average. But where we had been negative, now we are turning back to positive. Seeing that same thing here in the short term as well. And we were above average with volume. And I think it was Monday, we were below average with volume, not surprising, but so far we've been seeing above average volume. Sentiment got the latest reading from Investors Intelligence. Now, this came out November 5th, so They're still more neutral, coming in at 2.61. Still above the moving average here with the Ulcer Index. That may come down if we see more gains to the upside. The VIX is what really dropped down, both with the line chart dropping below the moving averages and the bar chart. So a lot of fear has come out of the market. And the VIX of the VIX also saw a real big decline. And the momentum has now shifted to down for the VIX. And here's the seasonality. Maybe we're right at the beginning of November. Seasonally, we see a spike right here. If this continues to go down, that would match up more with what we have seen historically. But now the skew index is back up here in the red area and it suggests there still might be more to come. We're not really sure if that means an up or down move, but it's back up into this area where it's expecting some kind of a big move. We were up with this fear gauge where we were down with the other fear gauge. So we've got some adjustments going on with the market here. The equity put call ratio really declined on the daily chart. So now it's back to going down on the 5-day chart and barely starting to go down on the 10-day chart. Saw a real drop off in volatility risk premium, had been getting really high readings with a big update. Now we're coming into the top end of the band here where it's more neutral. Saw an improvement, but not an all-time high here with the advanced decline line based on price, seeing a little bit better based on volume, but still not surpassing this previous high. Look at this monster climb up in new highs right here, but not really enough to turn our 5-day positive. We are starting to go back up with the 10-day, but just a gargantuan expansion of the new highs here and showing an improvement and trying to cross back above the moving average with accumulation distribution. Now the boom indicator, and okay, we're not far away from the moving average. This is a modified MACD, so it's not a true indicator of how far away are we from the moving average. So this is positive, but we want to keep going above this and then see the red line turn back up to stay even more positive. And we've switched over back to positive with the 19 and 39-day advanced decline ratio. They both crossed back above zero, seeing an improvement here, but haven't turned positive with the Chaikin money flow. This was kind of giving us a sign here. We came down to an extreme negative reading, and we've been bouncing up off of that ever since with the Chaikin oscillator. Seeing an improvement, but we have not crossed positive with the vortex. And with the cumulative advanced decline line for the S&P based on price, not setting an all-time high here where the S&P did, and the based on volume also an improvement, but not surpassing this previous high at least yet. And both the S&P and NYSE advanced decline line showed a real improvement here. And the cumulative advanced decline line for the NYSE setting a new all-time high, seeing an improvement back above the moving average with the regular NYSE advanced decline line, as was this other NYSE advanced decline line. The common stock on the NYSE showing a real improvement here, both based on price and volume. Seeing an improvement with the advanced decline line, coming back above the moving average with the NYSE common stock. Still, we came down and bounced off the moving average with the S&P. A big improvement with the mid caps and a real improvement here with the small caps. And we're back above 50 with those stocks inside the S&P above their 20-period simple moving averages. So that has now turned back positive. And we're also back to positive with those stocks above their 50-day moving averages, going back up with the 100-period moving average study and the 200-period moving average study, and seeing volume just spiking up here and setting a new all-time high. We do have some pivot points right here, these dashed lines, which may act as overhead resistance on this chart. And this is what I talk about, the rate of change from Tuesday to Wednesday. We might have overdone it. It's a pretty big move in the context. I mean, we were down here and we shot up here. So from one day to the next is picking up that it might have been overdone. But we're not seeing extreme readings with the advanced decline ratio. But we are seeing it here on the rate of change. But we are also improving here with the 20, 50, and 200-day moving averages of the S&P. We're already extreme positive with the Stochk RSI, Williams percent R, CCI 14 and 20. We're extreme positive with the short-term stochastic coming back up to the midpoint with the intermediate-term stochastic starting to turn up below the midpoint with the long-term stochastic. And we're hitting the upper Keltner band here. So we might have overdone it on a short-term basis according to the force index. Seeing a real improvement here with the short-term trend where we came back above the green line and the blue line, that's turning these lines back up. So that's really improving things in the short term. And we're back above all, or I should say both, the simple and exponential moving average based on 20 periods. So now the short-term trend has turned back to positive. And we're not necessarily extreme here with the standard deviations chart. We're right on the border between the +2 and +3 channel. So we're not extreme according to this. Balance of power, still negative, but improving. And you're going to see a lot of that in these charts. Looking better here with the 50-period moving average. Above both of the lines are starting to turn back up. The go, no go went from more negative back to positive with the dark blue bars. We're exceeding the highest high value right now, well above the midpoint. The TTM squeeze actually showed an improvement here. You might want to chalk this up as darn right positive. I mean, we've just been declining, declining, declining. Ticked up just a little bit, even though it's still negative. But that's much different than what we had been seeing. Coming above the moving average here with the standard deviation. Again, this does not measure direction. This measures speed. It's picking up this huge gap that we saw higher. And the ease of movement just barely starting to cross back above zero. So it's turning positive. The Arun is already extreme positive. It just kind of was out to lunch there for a number of days. The green line are the buyers, the red line are the sellers, and it's showing that the buyers are in full control as of right now. When it compares those two lines, that's how we get the oscillator, and it's getting up to about as high a rating as it's capable of getting. So that's overextended to the upside. And we're crossing back positive with the McClellan oscillator for the S&P. So we're starting to turn up with the summation index based on price and volume. Crossing back above zero with the McClellan oscillator on the NYSE. So it's really hard to see, but we're starting to turn back up with the summation index based on price and volume for the NYSE. Crossing above zero with the Swenlin trading oscillator based on price and volume there. Trying to show some improvement, but still negative with the PMO as far as momentum. Turning back up based on price and volume. Seeing a real improvement here with the PMOs above that are rising. The buy signals are starting to go up. We're starting to turn up with the PMOs that are above zero. And we continue to be positive with the Elders Impulse system for the S&P. We've gone from negative. We were negative for 4 days. Now we're positive with the dot underneath with the parabolic SAR. Turning back up, but still negative with the slope oscillator. The MACD, still negative, but improving. All of our oscillators, except for the long-term ones, are starting to turn back up and showing some improvement there. The Copic curve, negative, but improving. Sean trend meter coming into this initial extreme positive area, crossing just barely back above 50 with the money flow, crossing above 50 with the ultimate oscillator, crossing above 50 with the RSI 14 and 9. So short and intermediate term, seeing a real improvement. Above the moving average with on-balance volume, and here's the percent B indicator. We closed above the upper Bollinger Band. That tends to not last very long. So are we going to see a decline in price? The band will have to come up, or a combination of the two to work off this extreme reading. We're above all the plotted moving averages again here. And we're kind of far away from the 20-period moving average and 50-period moving average as measured by this version of the boom indicator. Seeing an improvement with the NYSE bullish percent index. So now it's going back up with the S&P bullish percent index, crossing back above 50 and improving with the NASDAQ 100 bullish percent index. Well above the little mini rainbow, showing that we're well above the open, high, low, close, simple moving average based on 20 periods. If we see some kind of decline, we'll be watching to see if any of these lines provide support. And I showed this in yesterday's video. We're seeing an improvement here with the Ichimoku cloud, well above the cloud itself. But the blue line was in danger of crossing below the red line. Now they're both turning up. And the green line, which is back here, it's really improving as well. So this chart is showing a real improvement. Turning back positive with a Heikin Ashi with an open candle. We're positive with the Kigi chart. The Renko chart is positive. And the 3-line break is positive. So all of our trending charts are switching back more positive. And where we had 2 O's drawn in, well, now we have 4 new X's and a new signal, an ascending triple top breakout. Woohoo, setting an all-time high with the S&P. Long term, still looking good with our 150 and 200-day moving averages here. Positive across the board with the Keller market model. Really no changes here. Still negative with bonds in the short and intermediate term based on price. We're negative with commodities in the long term as well as the dollar. And a lot of the real growth there is financials doing really well. Discretionary did well. Technology did well. Communication did well. Real estate and staples and utilities, which and healthcare. These healthcare was barely up, but these are the areas that we tend to think are more defensive. They were down while the more growth and economically friendly areas ended up having good days. And not a lot of red here. We did see utilities had a BPI cross below 80, and that was right after the open. And we've got the S&P setting all kinds of all-time highs, the Dow setting an all-time high, the Nasdaq 18.5, 18.6, 18.7. Then it went down to 18.2, 18.3, 18.4. Blah, I'm just kind of all over here. Staples, another defensive sector, has dropped below 50 with its bullish percent index. And the materials, that could be the tariff kind of thing. That could be more on the negative side. The BPI is crossing below 50 there. But everything else was ended up being really positive with the S&P getting above 5,900 here. So looking pretty good. Both the equal weight and the regular S&P 500 were pretty much in lockstep with each other. And I wanted to show this too, because instead of using the Dow to study Dow theory, here's the S&P setting an all-time high. Here's the Nasdaq setting an all-time high. And then to break this down more, the equal weight is setting an all-time high for the S&P, and the equal weight QQQ is also setting an all-time high. So we're seeing across the board all-time highs here, with the Dow just screaming up here, up 3.5%. My goodness. The diamonds, yeah, they're positive. You could see a green bar right there. The NASDAQ setting a new all-time high above this R1 pivot point. The NASDAQ 100 also just barely setting an all-time high here above this pivot point. Positive when we look at the Elder's Impulse system for the Qs. The momentum is still negative, but we're really turning up with the momentum for the NASDAQ 100. We reclaimed the 20-period moving average here with the QQQs. Small caps just breaking out. Not an all-time high, up over 6% here. Is this it? Is it finally going to happen now? We've had so many false starts here in 2024. Is this finally going to do it and really help the small caps to do better? And we look at the Russell 2000 small caps, already extreme with the RSI. Really looking solid here based on price above the 50-day moving average. And we switch back over to positive with the momentum. And yeah, we're positive with the small caps, with the Elder's Impulse system. Mid caps setting an all-time high and positive with the Elder's Impulse system. The Wilshire setting an all-time high, a broad market measure, setting an all-time high with the total U.S. stock ETF. This is the transports, just chopping along sideways. And if you look here and you go back to the previous all-time high, that was set in 2021. We finally were able to get above that, and that could really help the economy too if the transports are doing better. Financial sector setting an all-time high. FANG index not at an all-time high, but looking pretty solid. Apple was actually down 1/3%, still under its 50-day moving average. Amazon up 3.8% to an all-time high. Microsoft still below the moving averages here. We're not out of the woods yet as far as a potential death cross. Google was up almost 4% above its 50-day moving average. Meta was actually down a little bit, but still above its 50-day moving average. Nvidia up over 4%, setting an all-time high. Tesla doing really well, not to an all-time high. Now, some of this might have to do with Elon Musk and with the Trump victory because Musk is going to be involved in that. But Tesla has been doing better. They had a really solid earnings report that was well received. And Netflix setting an all-time high here. So folks are liking the movies that they're watching. Not really seeing much of a change when we compare U.S. stocks to world stocks. A little bit of a decrease here with the short term, still flattening out with the longer term correlation. Oil just kind of down, still in the low 70s. And the dollar just shot up into the 105 range. Now, at some point, this could impact stocks if the dollar keeps going up. And we're really going up here with the 10-year yield. Now they're a little bit worried about inflation. They're worried about maybe too much economic growth. Thursday session, that whole scenario could go away and we could create a new scenario. That's how the market works. but the 10-year yield is going up, and we're going down with the 10-year based on price. Not really seeing much of an improvement with the Qs to S&P. They're both setting all-time highs, so they're both performing quite well. So we're not seeing really with this ratio where one is massively outperforming the other one. Where we're seeing an improvement is discretionary to the S&P, and both growth and value had good days on Friday on Wednesday with the large caps. So we're right at the moving average with the large caps, seeing a real improvement here with the mid cap and small cap growth to value ratios. Coming back up, seeing how the S&P was up and the utilities were down. If we can see this continue to go up, that would be more positive for the S&P. And we saw a real drop off since staples are now really underperforming the S&P, and that's positive for stocks. So what's our outlook? We are now back to positive. The other indicators that are still negative are showing some improvement. We're switching what could be into growth mode here. That could change. But at least in Wednesday's session, it's like we're off to the races. The U.S. economy is looking good. We're happy the election is over. We want to buy stocks, and we're going to buy value stocks as well. We're just happy with everything. And we are in a period now from November, December into January of positive seasonality. This is kind of the bigger day for economic reports. We're going to get jobless claims, productivity and unit labor costs, wholesale inventories. The big one is going to be the FOMC decision at 2 p.m. Eastern time, and we're going to get consumer credit. So I'll really be watching for the jobless claims and the productivity and unit labor costs. Then I'll take a little bit of a break and then see what the Fed has to say. And then all the geopolitical things, because they could come back in at any time. Then on Friday, we're going to get consumer sentiment. And here is just a look at what the previous readings were and what they expect to happen at the Fed meeting. Seasonality, we're positive across the board going back to 2002 with the Dow, S&P, and NASDAQ. Thursday is not the most positive day, but it's been positive. It was positive in 2023. It's the most positive day in 2024. And I still don't have the Stock Traders Almanac calendar here, but we're kind of coming into a period of potential weakness according to Tom Bowley's research. I had a pretty good start to November. Now that we get into the 7th and 8th, this is where sometimes we see some negativity here with the S&P. And you notice airlines and trucking. These are transportation areas, and they tend to do well now. You got to fly grandma home for Thanksgiving. You got to truck those gifts off to the grandkids. And these areas tend to do better right about now. We're seeing less of an impact of the blackout period, so stocks can come in and start buying back their own shares. And Carson has positive seasonality going well into January. Now that the election is over, we typically will see positive seasonality here. We also see positive seasonality based on 2020. And then here, another chart. We're looking at November. Average return up 1.5%. We're up 68% of the time. So what's the warning signs? We still have this Hindenburg almond in the background. We'll just have to see if it's going to, the more time that passes, the less relevant it will become. But some of these signals can be triggered over a month or 2 months before they actually kick into gear. So we don't want to just dismiss it. We just want to know it's there. We are showing an improvement with our oscillators in the Copic curve, but they're still negative. The Vortex is improving, but also still negative. The NASDAQ 100 momentum is negative, but improving. Kind of a long list again here. We're turning back positive with accumulation distribution, seeing some improvement, but not quite full-blown positive with the Chaikin money flow and the Chaikin oscillator. It's negative, but it's bouncing up after giving us an extreme negative reading. And now I've switched growth to value and discretionary to staples over to the positive side. We'll have to see if we get more follow-through with that. Both the 5 and 10-day equity put call ratios are going down. That's positive. The advanced decline lines are improving, and we're above 50 with the 20 and 50 period moving average studies. They've turned positive. The parabolic SAR is back to positive. The Swenlin trading oscillator has turned back to positive. The McClellan oscillators and summation indexes for the S&P and NYSE are now back to positive. And the bullish percent indexes are now going back up for the S&P, NASDAQ 100, and NYSE. Ease of movement, money flow, and the ultimate oscillator have all crossed back above their midpoints and are positive. And the financial sector is still looking really solid here. So our conclusion, we're back to positive. We do have historical positive seasonality. We're going to be waiting right now. What's the FOMC going to do and say? In the short term, that's where the most reaction is going to be to the Fed meeting here, but we are positive. We do have a long list of extreme positive indicators, which could suggest good momentum. We're still positive in the intermediate term, but showing an improvement there. We continue to be positive in the long term. Thank you. I really hope you have a great day, and I will talk to you in the next video.